Hello, guys. We're going to be starting here in a few minutes. We just want to allow a few more extra minutes for everybody to jump on. I hope everybody's having a great day so far. Hello, guys. If you're jumping on, we're allowing an extra minute and we're going to get started. We just want to make sure that we have more attendees sign on, and we'll start here in just about another minute. Alrighty, guys, we're going to go ahead and get started. My name is Dr. Sammy Meese. I am located in Georgetown with my own practice, Chiropractic Center of Georgetown. I am NextGen's chairperson for our group here that we started a couple years back. A couple things about NextGen. It is a great group of doctors to get involved with. It's for anyone who has graduated within the past 5 years and wants to network, get involved, find mentors, and much more than that. If you guys would like to find out more information about that, you can definitely reach the TCA office and they can get you in contact with me or my co-chair, Dr. Stephanie Paiva. She is out in Leander, Texas. And we're going to go ahead and get started with the webinar. But first, I want to introduce Joshua Massengill. He's going to present our TCA's Next Gen webinar, Contracts and Business 101. He is a native Texan and graduate of Pepperdine University School of Law and the Strauss Institute, and the nation's top-ranked dispute resolution program. As an attorney and lobbyist for the TCA, he is widely recognized as being knowledgeable about legal issues facing Texas doctors of chiropractic. He assisted in drafting Senate Bill 679, a landmark bill authorizing chiropractors to jointly own medical entities with physicians and help guide to bill the passage. Joshua is the principal attorney at Massengill Attorneys and Counselors at Law in Austin, Texas, a law firm that caters primarily to doctors of chiropractic and other healthcare professionals. Before we begin, a reminder of a few housekeeping items, please. We will be recording this session to make it available for all members later on. Because of this, you've all been muted. Please keep your computers on mute until you want to jump in on a discussion, as we'd like to make sure our recording of the presentation is clear and free from any background noise. Please hold questions, or if you have questions, you can put them at the bottom of your actual webinar in the Q&A, and we will answer those roughly around 11:45, 11:50, whenever Josh gets done with the presentation. And at the end, if you have any more questions that you want answered, please feel free to reach out to the TCA through the email, and you can email them at tca@chirotexas.org, and Texas is spelled out Texas. And now I would like to introduce our speaker of today's webinar, Joshua Massengill.
Thank you. Appreciate that introduction. Let me just see if I can get this presentation started. Okay, so the topic that we're going to be covering today is Contracts and Business 101. And when I talked to Dr. Meese about what her vision was for this program, she had really just one criterion, and that was don't be boring. So keep it light. Don't bore everybody to death. So I'll do my best. I think what we're going to cover today includes some really helpful information, some good stuff for you. It's actually an abbreviated version of a presentation that I've given as a seminar at TCC and at Parker and in years past. Again, just try to kind of take the juiciest nuggets out of that and condense it down into a shorter presentation that would be useful, I think, for the folks on this webinar. So we'll try to pound through this, and then there will be some time at the end for questions if you have any. Before we get started, a couple of disclaimers. I'm an attorney, so you know there has to be some boilerplate disclaimers right off the top. I am an attorney. I'm not your attorney. I could be, but right now we're not engaged. And so what that means is I can't give you legal advice. The presentation is going to include just general legal education, not legal advice. I couldn't give you legal advice without knowing, more about your particular circumstances. And then obviously, basically everything we're going to talk about today is extremely Texas specific. So if you're in other states, your mileage may vary. With that out of the way, we'll get started. Here's a look at what we'll be covering in today's sort of mini course. We'll talk about contract basics, so just some fundamentals of contract law. We'll talk about business entities, why you might need one, what the different types are, maybe give you some tools for thinking about that in a sort of a coherent way. And then we'll cover some compliance issues like START law, the federal AntiKickback Statute, and the Texas Patient Solicitation Act. And then again, we'll do some Q&A at the end. So diving right into contracts, I am about to condense for you into about 2 minutes the entire first year of contract law that you might get at law school. So buckle up. There are 3 ingredients to every contract. So if you're trying to determine whether an agreement is enforceable, there's 3 sort of fundamental things that an attorney is going to look for if they're evaluating it. First, there has to be an offer. We all know what an offer is. Would you like to buy this house? Or would you like to buy my car? That's an offer. There also has to be acceptance of that offer. Yes, I would like to buy your house, or yes, I would like to buy that car. So you have an offer and acceptance. And a lot of people think that that's all a contract is, an offer and acceptance. But there's actually a third ingredient to a contract that makes it legally binding, and that's a concept known as consideration. Legal consideration is sort of a fancy term that just means something of value. So some sort of value has to change hands. Sometimes it's money, sometimes it's something else, but that thing of value is called consideration, and that's what makes a contract legally binding. An example of this, just to kind of make the point, would be, let's say Joe says to Mary, I promise you I will give you $1 million tomorrow. I promise it. Take it to the bank. It's happening. If Joe doesn't make good on that promise, Mary can't sue him for breach of contract unless she gave him something in exchange for that promise. So in other words, just promising to do something is not a contract. Even if it's in writing, even if it's notarized and stamped and super fancy, it's still not legally binding until you have that legal consideration given in exchange for that promise. And that is sort of a basic concept that if you keep that in mind, it'll make it easier for you to evaluate contracts just sort of in your daily business as a chiropractor. A little bit of useless legal trivia. There actually are some exceptions to this rule. Times in which a court might sort of impose contractual obligations on parties when there wasn't really a contract. There's something called quantum meruit, which is an implied contract. There's a concept known as detrimental reliance, another concept known as unjust enrichment. These are all sort of fancy legal ways that attorneys try to use to get around the general rule that we've just been talking about. But really, at the end of the day, if you find yourself in court trying to rely on one of these theories to win your case, probably means you don't have the upper hand. So we want to avoid that by making sure that the contracts you're trying to enforce are legally valid and that they have these 3 ingredients of offer, acceptance, and consideration. Now, here are some traps that I have seen over and over again doctors fall into just by either being lazy or sort of being unaware. These are the things you need to watch out for when you're signing a contract. First, not having one, right? I mean, if it's not written down, it's just a he said, she said type of thing. And it's very, very difficult, often impossible to enforce an agreement that isn't reflected in writing. So you really do need to have a written contract. And I'd say that frankly, maybe like a third of the contract disputes that show up in my office are related to that, just not having a written contract. Beyond that, you need to keep a copy of it. It's not good enough that there was at some point a written contract. If you don't have a copy of it, you can't enforce it. And this is something I see over and over again, especially with new doctors. And here's a common scenario where that would come into play. Let's say you're fresh out of school and you're going to get your first associate position, and it sounds like it's going to be a great thing. And you sign that contract, and it has maybe a non-compete in it that is, for after the contract terminates, how many months, how many miles, where you're allowed to compete, and talks about, how you're supposed to be paid, and it includes all those details. And the doctor doesn't keep a copy. And then a few months go by and they decide maybe this job isn't what it was cracked up to be, and they want out, and they're trying to figure out how do I remove myself from this situation? If I want to go work somewhere else, or if I want to open my own business, what are my options? And they don't know because they didn't keep a copy of the contract. So that puts them in a sort of a sticky situation, because you can go to the employer and you can say, hey, I'd really like to have a copy of my employment contract. But often that tips them off that maybe you're thinking about leaving or whatever. So it puts you just really behind the eight ball. Make sure you have a written contract and make sure you keep a copy of it. And if you can do those two things, then you're going to be ahead of a lot of the people that end up in a lawyer's office. Another trap to watch out for is signing contracts in your personal name instead of as an agent for your business. So, when you have a legal entity like an LLC, and let's say you're going to sign a contract with a vendor. I'm trying to think of what a vendor would be to use as an example, maybe like BioFreeze or something like that, that's in your office, and you're going to sign this agreement with this vendor and obligate your business to do certain things. You want to make sure that when you sign the contract, you don't just sign John Smith, DC, because if you've done that, you may have accidentally bound yourself in contract instead of the business. A better way to sign it would be ABC Chiropractic by John Smith, DC, or, John Smith, President, ABC Chiropractic. There's not like magic language that you need to use. You just need to ask yourself, like, if aliens came to Earth and were looking at this contract and they knew nothing about you and they knew nothing about the circumstances, who would they say are the parties to this contract? And if you've signed it in your personal name, chances are you've given the impression that you intended to personally bind yourself instead of the business. So just be careful when you're signing contracts. Another one would be agreeing to burdensome non-compete clauses. And we'll talk more about this in just a second. But I see this over and over, people who they sign these agreements that have these really restrictive covenants in them, and they just aren't thinking too much about what will happen down the road, either because they don't have a lot of foresight, or because somebody once told them that non-competes aren't really enforceable in Texas, which is wrong. But that is a trap that I see people fall into fairly often. Another would be misclassifying employees as contractors. So for those of you who own your own clinic, this could be a pretty big deal. You say, I don't want to do the withholding. I don't want to mess with paying payroll. Payroll is a hassle. So I'm just going to pay everybody as a contractor. Well, maybe you can do that, but the IRS has some factors it looks at to determine, whether somebody is an employee or a contractor. And if you misclassify somebody, according to the IRS, you can find yourself in hot water, and we'll talk more about that in just a second. So those are some basic contract traps that I see doctors fall into over and over. Let's talk about non-competes, the fancy term for which is covenants against competition. A couple of things just to cover really briefly. Obviously they're commonly called non-competes. The rules surrounding non-competes in Texas are pretty simple. Basically, they just must be reasonable with respect to time and geography. And then, if they're not reasonable, if the court says they're not reasonable, a lot of times people think, well, that means the court wouldn't enforce it. They'd throw it out. In general, they don't. They blue pencil the agreement is what it's called, where they reform it to make it reasonable. So a court might say, well, this seems a little overkill to say 50 miles, but we will enforce, 30 miles. So that is something to look out for. Another requirement is that they can't stand alone. They have to be ancillary to some otherwise enforceable agreement, which means you couldn't just sign a straight up non-compete. Probably it would have to be sort of linked together with like the sale of a business or commonly like an employment agreement. So covenants against competition, non-competes, they are enforceable in Texas. People will tell you all the time that they're not. I don't know where that comes from, but it's wrong, because they are enforceable. They just have to be reasonable with respect to time and geography, and they have to be ancillary to some otherwise enforceable agreement, and they usually are. So be very careful when you're looking at non-competes before you sign. And if you have any questions about that, you should probably ask an attorney before you put your name on the dotted line. Now, employees versus contractors. We talked about that just a second ago. And let me just kind of give you the basic rundown. This is a major trap that people fall into. And the reason it's major is because the consequences of misclassifying folks as contractors when they're really employees, the consequences can be quite severe. The key distinguishing factor that the IRS is going to look at in determining, is this person a contractor or are they an employee, is the degree of control that the company has over the person. So if you are telling that employee where they need to be, when they need to be there, how they need to do it, how they need to dress, all of those things, you probably have an employee and not a contractor. Employees, the company is going to withhold the taxes, the Social Security and the Medicare from wages. They're going to do all that reporting. They're going to provide the supplies. The worker probably has some paid time off. Independent contractors, on the other hand, the company's not handling the withholding. They often provide their own supplies and equipment, and obviously they're not getting any paid time off. This is sort of a highly condensed, simplified sort of overview of how the IRS looks at these things, but just the general point of this is just be careful. And if you have any questions, you really ought to talk to an attorney about it so that you don't find yourself in a sticky situation. The reason is because, as I said, the penalties for misclassification are really severe. Another thing to look out for is that contracts often shift the liability of misclassification from the employer to the employee. And so what that means is that, like, even if you're sitting here and you're thinking, well, I don't really need to know this because, it doesn't really matter. I don't own my own business. I just work for somebody else. It may matter to you because your contract that you signed with your clinic may have shifted the liability for misclassifying you to you, which means if the IRS comes knocking and says, hey, you're misclassified, the company, you owe the IRS $30,000 for these back withholdings several years. The company then could point the finger at you and say, actually, doctor, your agreement says that if this happened, you would pay the difference. That's called independent contractor indemnification. So if you're looking for this in a contract to see whether you might have signed something like that, here are some clauses that you can look for in the agreement. It might be called relationship of the parties. That's what the heading might say. It might say something like independent contractor status or independent contractor indemnification. But if you are an employer, obviously you need to pay a lot of attention to this. But if you are a contractor, if you work for somebody and they pay you as an independent contractor, you need to look in your contract and make sure that that's spelled out correctly and make sure that you haven't agreed to bear the burden of penalties if the IRS were to come knocking. So that's just something to pay attention to. Now, let's shift our attention a little bit and talk about business entities. So, moving on from contracts into the world of business entities. The most sort of basic question that I often get is like, well, why do I need a business entity anyway? Like, can I just start doing business? Like, why do I need to go to all this hassle? There's a couple of reasons. Primarily, we do this to protect your personal assets from your business liabilities. So we want to protect your personal assets from the business that you're conducting over here. It also makes it easier for you to attract investment because you can give ownership in the business to other people. So if you establish an entity, we can give 5% of it or 10% of it to an investor or something like that. It makes it easier for you to sell your business because it exists as a legal person, separate and distinct from you individually. So when you're ready to retire, all we have to do is just sell the assets or sell the equity in that company to somebody else, and they can keep, operating. So it makes it easier for you to, transition into that next phase of life. It helps you manage the rights and responsibilities of business partners. So if there's more than one of you and you're in business together, we create an entity, we have an operating agreement, we have everything written down, and that allows you to manage each other's sort of rights and responsibilities and know kind of where you stand with your partners. So there's many reasons that you might want to form an entity. The next question is, well, okay, if I need an entity, what type of business should I form? Like do I need a corporation? Some people have professional associations. Like what is the difference in how do I choose? Here are some options. You've got sole proprietorships, you've got partnerships, corporations, limited liability companies, and then, as I said, you've got a bunch of other less common types of entities like professional associations, limited partnerships, limited liability partnerships, and on and on and on. But here's the thing. I tricked you, because these top two actually are not types of entities. They are just methods of doing business. So a sole proprietorship is like, hi, my name is Josh. I am doing business as Josh's law firm. That would be a sole proprietorship. Sometimes people call that a DBA, which stands for doing business as, which is just a nickname. It's not a type of entity. It's just a nickname that you use to do business. Partnerships also are not entities. They're just contractual agreements between people. But these entities here that are in yellow, corporations, limited liability companies, professional associations, those are actual business entities. And that means that in the eyes of the law, they are people. They are separate legal persons under the law. And they do provide you with liability protection. So these that are in yellow do provide you with liability protection. These that are in gray do not provide you with liability protection. One question I get is, well, what the heck is an SCorp? You ask somebody, well, what type of business do you have? And oftentimes they'll say, well, I'm an SCorp. The truth is, an SCorp is actually not a type of legal entity. It is a tax designation. So in Texas, most commonly, I've found that when people say I'm an SCorp, what they mean is I have a limited liability company that has elected to be taxed as an SCorp. So a corporation, if you form a for-profit corporation, it can be taxed as a C Corp or an S Corp. A limited liability company can be taxed as an S Corp. But again, that's a tax designation, not a legal entity type. Another thing to point out, beware of accidentally creating partnerships. So partnerships are like pregnancies, okay? You can do it on purpose or you can do it by accident, and you need to be careful about it because accidental partnerships can cause you a lot of trouble. They're pretty scary. Here's why. They require no specific intent to create. So people create them accidentally all the time. And you say, oh, what do you mean people create an accidental partnership? How would you do that? Well, to form a partnership, you don't have to fill out paperwork. You don't have to submit it to the Secretary of State. You don't have to go to a lot of formal trouble. You can create a partnership accidentally. Here's how that would work. I might say to my friend, hey, I have an idea. Let's go buy some goats and let's raise them, and we can keep them at my house. You pay for the food, we'll keep them at my house, and then once they're raised to adulthood, we'll sell them off to do whatever it is that people do with goats, and then we'll split the proceeds. Sound good? If my friend says, sure, at that moment, we've created a partnership. Didn't fill out any forms with the state, didn't write anything down, but we have formed a partnership. So you can create a partnership accidentally very easily. And the reason that's scary is that in a partnership, each partner has unlimited personal liability. So each partner is liable for 100% of the partnership's debts, even if they're only a 50% partner, even if they're only a 1% partner. So what that means is if you've got a scenario where like partner A rear ends another driver while working, partner B can be 100% financially liable for that accident, even though they weren't there and had nothing to do with it, because that's how a partnership works. Very, very scary stuff. So beware of accidentally creating partnerships. Now, what I want to do for you is just kind of plot out on a graph sort of where these entity types fall so that you can understand sort of the pros and cons that they offer. On the, what is this? The x-axis, we've got liability protection, and on the y-axis, we've got ease of operation. So you might have a sole proprietorship, which yes, is very easy to operate, but offers you no liability protection, okay? Easy to form, easy to operate, but doesn't do anything for you in terms of liability protection. It would fall somewhere up here in that upper left-hand quadrant. Partnerships, also fairly easy to operate, but again, even less liability protection than a sole proprietorship, because in a partnership, not only are you liable for your problems, you're liable for your partner's problems too. So these are not ideal. On the other hand, you could have a corporation, which gives you lots of liability protection, but is a little bit cumbersome to operate. You have to have annual meetings. There's some specific requirements for corporations that you have to deal with. And then that leads us to the limited liability company. And it's up here in the happy zone. It is both easy to operate and gives you all the liability protection of a corporation. And for this reason, the vast majority of entities that are created in Texas every year, and probably in other states, though I don't stay on top of that too much, are limited liability companies because they give you a lot of liability protection and they're easy to operate. So generally, as a chiropractor, if you're going to be starting a business, it's either going to be an LLC or a PLLC. So a limited liability company or a professional limited liability company. And that's why. And hopefully that graph makes that a little easier to sort of comprehend. Now, I keep talking about liability protection. Liability protection. What does that mean? What we're talking about here is something that's not just bestowed once and enjoyed forever. It has to be safeguarded and cultivated. So you form this entity, it gives you liability protection, but you also have to operate that entity in a way to make sure that you maintain that liability protection over time. It also doesn't apply to every type of liability. For example, malpractice. Malpractice is a personal tort. It's going to attach to you personally. You're still going to need a malpractice policy regardless of whether you're practicing out of an LLC or PLLC or whatever. So it doesn't apply to every type of liability. The example would be like, let's say Bob Smith, chiropractor, signs a contract with a vendor on behalf of his company. And if the company breaches the contract, it will be liable, but Bob's not going to be personally liable. So Bob has liability protection because he formed an entity and then signed the contract on behalf of the entity. That's good. That's a scenario where it works correctly. On the other hand, let's say that John Jones is a purchasing agent for XYZ Materials Company, and he negligently hits a pedestrian while he's picking up a load of supplies in the company truck. In that scenario, actually, the employee and the company are liable. The employee is liable because he's the one that committed the tort. XYZ company is liable because the employee was acting as its agent when he committed the tort. So, yes, these entities provide you with liability protection, but it doesn't protect you from every type of liability. And again, it's easily squandered. One sort of moment of not thinking carefully and signing contracts willy-nilly, and you've squandered the liability protection that your entity would afford you. How are some other ways that you might squander your liability protection? Well, one way would be to not have any internal operating documents. So just file your papers with the Secretary of State and don't create an operating agreement. Don't keep any meeting minutes. That could be a way that somebody could pierce the corporate veil, so to speak, and get at you personally. Maybe you don't keep minutes. Maybe you sign contracts in your personal name, which we've talked about already. Maybe you're commingling funds, so you're paying your personal mortgage straight out of the company bank account or something like that. Commingling funds is a way to squander your liability protection. Now, let's talk just briefly about some restrictions on the type of entities that people can create. Here is a lovely chart put together by the Texas Secretary of State. And what they did was they combed through the Texas Business Organizations Code written by the legislature and all their wisdom, and tried to just put together in this chart which types of professionals are allowed to create which types of entities. And as you can see, it is a hot mess. So if you're a midwife, you can form up here, I'm looking at this top of this second column, midwives. They're allowed to create a professional corporation or a professional limited liability company. They are not allowed to form just a regular for-profit corporation or a regular limited liability company. So they're limited in the types of entities that they can create. Let's see, what's my other favorite one on here? Yeah, like hypnotherapist. The hypnotherapists are limited to the types of entities that they can create. Embalmers. I think isn't there like an equine dentistry? there literally is a profession of, equine dentistry, and they are only allowed to form a professional corporation or a professional limited liability company. So all that to say, you have to be very careful about the entity type that you choose to make sure that it's one that you're allowed to create. Now, the good news for a chiropractor is that you'll notice right here, here's chiropractor. You check all the boxes. You are allowed to create any type of entity you want, just about. And as I'm looking here, as far as I can tell, you're the only professional type on this chart that's allowed to form any type of entity you want. So congratulations, you have a lot of freedom there. But there are some pros and cons to the different entity types, and it's a little too detailed to get into for the purposes of today's webinar. But if you were thinking about striking out on your own, you would probably want to talk to an attorney about these options to understand the ramifications that decision will have for you down the line. So not everybody can form every type of entity. Finally, let's just talk about some key questions that you probably want to cover before you form a business entity. These are kind of the things that you need to be thinking about and that would be addressed, in your legal documents. What is the company's purpose? Why are we forming this company? Who are the owners? What percentage does each owner own? Is there any ownership that's going to be reserved for future issues? Are we going to go ahead and issue all of the shares, so to speak, that we have? Are we going to hold some back to be issued to future investors? Does everybody have the same rights and responsibilities, or do we have different classes of owners? What are each owner's initial capital contribution be? So how much money are they going to pony up? Are owners going to have a capital commitment, meaning, eventually they'll be required to put more money down? How are we going to distribute profits? When are we going to distribute profits? How are we going to allocate losses? What happens if a member dies? What happens if a member divorces their spouse and their interest gets assigned to the ex-wife or whatever? Are members going to be allowed to sell their interests? All of those are questions that we need to think about when you're forming an entity, and that we would address when we put your bylaws together or your operating agreement together. And just straight talk, LegalZoom ain't going to help you with any of that. So, you really ought to think about getting with an attorney before you slap this all together. Another thing to just kind of think about that relates to entities is the employer ID number. So these companies, as I've said, are legal persons. They are persons in the eyes of the law. You have a social security number. Your company has what's called an employer ID number. And that's like a social security number, but it's for your company. And it's used to identify your company for tax purposes. But just like your social security number, It's often used for other non-tax purposes. And in your case, probably the most relevant thing that it would be used for that you need to be aware of is insurance credentialing. So what that means is that once you get that EIN and you establish yourself, credential your entity with the networks, you can't just go changing entities willy-nilly, because if you do, you'll get a new EIN, you might have to re-credential with the networks, blah, 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 blah. So that was a fast and furious rundown of business entities and some of the basics there. And finally, kind of as our third and final chapter, I just want to talk about some compliance issues that you need to be aware of. And this stuff is dense. So I'm not going to get down in the weeds on it, but I do want to just cover some basics that I think are applicable to you, and that if you will sort of internalize just the things in this presentation, you will instantly be in the top 10% of doctors and you will keep yourself out of a lot of trouble if you can just sort of grasp some of the basics of these particular laws. Just a quick overview, the government is the single largest payer of healthcare services in this country. And the government has very deep pockets. So because they're all up in healthcare and because they, have so much money, that creates some very strong incentives for providers and other healthcare companies to game the system. And in response to that, the government has had to adopt very strict laws about, what it allows and doesn't allow, to try to offset this extreme incentive that exists to game the system and bilk the government out of money. And the result of this is that many business arrangements that are not inherently unethical, and as a matter of fact, might be common in industries other than healthcare, are nevertheless illegal for chiropractors. I'm going to rewind and do that again so that you understand. Many business schemes that are commonplace for landscaping companies and pool companies and whatever else, and that your CPA might think are a great idea because they've seen that done in all sorts of other industries, it might nevertheless get you sent to jail as a chiropractor. So what that means in just really practical terms is, when you're hiring a lawyer, they better be a healthcare lawyer, because basic business law isn't enough to keep you out of trouble. When you're hiring a CPA, they better be somebody who has just a basic understanding of healthcare and the healthcare industry. Otherwise, you can end up in a world of hurt. And it's your responsibility to know and understand these laws. Like your physician level providers, this is your responsibility to know this. So you need to pay attention. And again, a lot of these are Byzantine rules that do not always mirror common sense. So if I were to ask you right now, is it legal to murder someone? You're going to say, no, Josh, that's not legal. Well, how do you know? Well, I just know, right? You just know. Now, if I said, tell me the code section under Texas law, cite the code section that says it's illegal to murder somebody, can you do that? No, none of you are going to be able to cite that to me. You just know, you have this inherent understanding that murder is wrong and it's illegal and you shouldn't do it or you'll go to jail. You know that because it mirrors common sense. In the world of healthcare, it isn't like that. It may not mirror common sense. So all sorts of things that are commonplace that you see lots of other people doing that don't seem inherently unethical can nevertheless get you in a lot of trouble unless you learn these rules I'm about to give you. This right here is the dumbest thing that I hear people say. And I want you to be aware of it because it is a warm blanket that doctors wrap themselves in when they're involved in something that they shouldn't be. And they say, well, look, I know you can do it because I know a lot of people that do it and they get away with it. So the guy down the street, this is how he does it. He's done it this way for 20 years. Well, sorry. That doesn't mean it's legal. So this is a very silly statement that you should not ever use in a lawyer's office because it's utterly meaningless from a legal perspective. Let's talk quickly about Stark as we work our way through these compliance rules. Stark law prohibits physicians from referring patients for certain designated health services paid for by Medicare to any entity in which they have a financial relationship. So the Stark law is often called the physician self-referral law. It prohibits self-referrals. It does apply only to Medicare. So we're talking just, about these federal patients. It's a civil statute that has civil penalties, but it is what we call a strict liability statute. So a lot of crimes or things that are illegal require proof of intent. So it's like, well, you have to violate the law and know or reasonably should know that you're violating the law if we're going to get you in trouble. I mean, that just seems fair. But this is a strict liability statute, which means it doesn't matter whether you knew or didn't know or whatever. It's just you violate it, you pay the price. Doesn't matter whether you knew, whether you intended to violate the law, doesn't care. So accidental or unknowing violations are very common. And that's the dangerous thing with Stark, is that it is a strict liability statute. Then you've got the Anti-Kickback Statute, which oftentimes you'll see abbreviated AKS, or just called, the Anti-Kickback Statute. It prohibits the exchange of anything of value for referrals for services that are payable by a federal program. So exchanging anything of value in exchange for referrals. This, unlike Stark, includes criminal penalties. So criminal orange jumpsuit type penalties. And could be fines of up to $25,000 per violation and 5 years in prison. 5 years in prison. The definition of what constitutes a kickback is insanely broad. But the good news is there are many carve-outs called safe harbors that permit arrangements that would otherwise violate the statute. So like space rental agreements, equipment rental, etc. So this is a rule that is so broad that it really necessitates you having a lawyer involved when you're going to lease space to someone who may be, referring patients to you, or doing a marketing agreement with some company that agrees to send you X amount of patients or whatever. It is broad enough and complex enough that it really necessitates using a lawyer a lot of the time when you're putting together contracts that involve patient referrals. And then finally, you've got the Texas Patient Solicitation Act. Now, you'll notice that Stark and the federal anti-kickback statute in general just apply to these federal programs and stuff. But the Texas Patient Solicitation Act forbids any licensed healthcare entity from knowingly paying remuneration, fancy word for money, for the solicitation of patients. And so it basically takes the anti-kickback statute and applies it, codifies it in state law and applies it to private insurance and even cash pay. So there are criminal penalties, again, applies to private insurance and even cash payers. And so the bottom line is that these rules that I've been talking about for the last few minutes, just short answer, they apply to you. Even if you don't take Medicare, even if you run an all cash practice. A lot of people think if you run an all cash practice that it's just like the Wild West and no rules apply to you. That is incorrect. These rules apply to you either directly because you take federal patients or sort of indirectly through the Texas Patient Solicitation Act. These rules apply to you and you need to know them and you need to follow them. So on that happy note, that sort of concludes my prepared remarks. And again, I know this has been sort of fast and furious, but I hope that the information that you've gotten today is going to be useful to you and is the sort of thing that is just going to help you in your daily practices. But with that, I'm open to questions. So Dr. Mees, I don't know if we have any questions in the Q&A, I'm happy to try and answer.
We have a couple. The first one is an LP. Is an LP the same as an LLC? If not, how does it compare?
Yeah, so an LP stands for limited partnership, And in a limited partnership, you have two types of partners. You have a general partner and then a limited partner. And the limited partners have limited liability. So it is similar in some ways to an LLC, but they're certainly not the same thing. And in general, they're a little more complex. So if you're just planning on forming a business entity or something, I would strongly advise that you look at something like an LLC as opposed to some of the fancier types of partnership arrangements. But again, when we talk about partnerships, sometimes what people mean is a legal partnership, and sometimes they're referring to like an LLC that might be treated as a partnership for tax purposes. So the language gets a little confusing, but just to answer the question, no, an LP is not the same thing as an LLC.
Okay. And then we also have a couple of questions about the same thing. What is the main difference between an LLC and a PLLC? And why would Texas chiropractors choose one over the other?
That's a great question. Yeah. So the P in PLLC stands for professional. And so professional LLCs are restricted in their ownership to people that practice in that particular profession. So if you have a PLLC that was formed for the purpose of practicing chiropractic, only chiropractors can own any part of that business. So what does that mean? Well, it means that you can't have your spouse own part of it. It means that you can't take investment from a layperson like a rich uncle who wants to invest in your business. It puts some limitations on you. So what I tell clients is when they come in and they say, I'm a chiropractor, I want to form my own business. Should I do an LLC or a PLLC? Usually the determining factor boils down to whether you might ever choose to integrate medicine into your practice. If you ever wanted to sell part of your practice to a physician and then hire a nurse practitioner and do, like a medical integration, it probably makes sense to go ahead and set your business up as a PLLC, because that would be required if you were ever going to do, a medical integration. If not, I'd say just form an LLC. That way, if you ultimately decide you want to take investment from a layperson, you can, you don't have that restriction to contend with.
Okay, awesome. As of right now, we don't have any more questions. However, I'm going to wrap up with some things here at the end. And if you guys have any other questions, go ahead and put them in the Q&A box while I wrap up some things. And Josh, a comment to you, someone wrote that you were very entertaining today. So good job, bud.
Thank you.
All righty, guys. Josh, thank you again for taking your lunch today and be a part of Next Gen Jumpstarting Series. And thanks to everyone who attended today. A quick reminder that registration is still open for Chiro Texpo 21, TCA's annual event, which will be held June 11th through the 13th in Allen, Texas, with an in-person and virtual options available. You can get more information at chirotexas.org/ChiroTexpo. It will put a link in the chat below. Hope to see you there. Let's see if we have any more questions. No, Josh, as of right now, we don't. So we're going to go ahead and close the seminar. And again, if you guys come up with any other questions, if you want to rewatch the webinar, a link will be emailed to you either today, this afternoon, or hopefully by Monday of next week. And if you come up with any more questions, don't forget to email the TCA office. And if there are questions that if we can't answer them, we will provide a person for you to get in contact with, and we will get those to you. Again, thanks, Josh, for your presentation today. Thank you guys for the attending, and we will see you next time. You guys have a great weekend. Bye, guys.